Pretty horrible way to start the week. If we have a look at the market, it was a sell-off all across the board. Every single sector of the market ended up finishing lower on the market today, but the three worst sectors were property, utilities and the telecom space. All three of these sectors losing more than 2%. These three sectors, of course, some of the best performing sectors on the market. Before the sell-off today, property has been up 29% over the past year, utilities up by 20% and telecom up by 24%. Of course, it was all about the US today and expectations around US interest rates. We saw a very good US number on Friday, and of course, good news is bad news at the moment because that increases the chance that we're going to see rates rise more quickly in the US. So expectations around a quicker interest rate rise in the US really driving a lot of the moves that we've seen today. If we have a look at expectations, the Fed funds rate are pointing to a 50% chance of a rate hike in the US in June and a 100% chance by September. And if we have a look at the impact that the low funding environment or the zero interest rate policy of the US has done around the globe and the impact it's had around the globe, I guess there's been two key impacts. One is the very low cost of funding, and two is that high yielding areas do seem quite attractive. So if we have a look at the sell-off in property, utilities and telecom, not only is it about the sell-off in yield that we've seen, but also the sell-off, I think, in areas which have high levels of gearing, because that very low interest rate, the low US dollar, has been a key funding source of growth around the globe. And you only have to remember the global financial crisis and the high levels of debt and the impact that we saw during that time to see the concerns that may be arising from high levels of debt at a time when the US is raising interest rates. So those high yielding sectors being sold off for two key reasons. One is the attractiveness of the yield to overseas investors at a time when US interest rates are rising. And secondly, these areas and these sectors are also areas with high levels of debt. Property, utilities, telecom, they have high levels of debt because generally the telecom and the utility space, very strong cash flows, usually very predictable cash flows, and thought of as defensive areas. And of course, property, generally you borrow a lot to buy these properties, and the yield is usually quite predictive as well. So unfortunately, a horrible day for the Aussie share market. Every single sector lower, but those high yielding areas and those highly geared areas, the biggest ones to sell off today.
Narrow it down to the banks, whether or not now is the time, if people think that the yield stocks are going to continue to be sold down. I think we had a high-profile hedge fund manager out of Britain suggesting the Australian or any economies linked to China are likely to go into recession. He was basically shorting the Aussie market, the dollar, and thought the banks were going to get a touch-up. Your own view on whether or not people should be looking to take profits on the banks?
I think when you look at the action today, you have to really differentiate between domestic selling and international selling. And what was clear today was that there was international selling going on. Now, today's volume of $4.6 billion, that's extremely high for a Monday. And not only that, we saw a lot of Australia being on holidays, so not even usually on a day like this, you'd expect an under $3 billion day. So in conjunction with the fall that we saw in the equity markets, we also saw a fall in the Aussie dollar. So that's international participation. Because if you have a look at here domestically, we're still talking about interest rate cuts. Those high yield players still looking relatively attractive. But when you're seeing the currency falling as it is and the US currency strengthening, what you are seeing is international selling. So we'll continue to see that pressure. I guess the banks longer term, you really want to see what's happening here domestically as well, because of course Australians are massive buyers of Australian stocks, and as long as the property market stays quite high, we're still going to see quite a bit of demand for those banks. But everything's cyclical, including the banks, and once you see that cycle turning, you can see it turning quite rapidly. And what we've talked about for a number of months here on the Business Channel is how crowded the yield trade is at the moment. It's almost like everybody's on the same trade at the moment, and the fact that we are looking at US interest rates rising sooner rather than later, we are seeing a massive reaction to that. And then of course on top of that, we've seen downgrades to expectations around China's growth, which was seen last week. So we are watching commodity-based stocks very closely as well. We saw iron ore prices reaching the lowest level since the steel index started to publish the spot prices back in 2008. And of course, quantitative easing and the zero interest rate policy out from the US has been fantastic commodity prices. Back when we saw quantitative easing 1 or QE1, we saw copper prices up 63% during QE1. We saw gold prices up by 73%. And as that reverses, we are seeing some longer term trends, especially in the US currency, also reversing. So we are seeing an inflection in terms of the popularity of the Australian currency and, of course, the yield trade as well.